This is episode number 4, and this one's titled Why Bitcoin is the Only Asset That You Need. And we're going to talk about a couple deep topics, I think, a little bit more technical than the first 3 shows. And maybe we should just kind of go back to do a bit of a review here. So we talked about the expectations versus the reality of how the public perceives Bitcoin versus how it is. We talked about all the different use cases in Bitcoin, and that's kind of what we've been using to create these lessons going forward in these chapters, as we're going to call them going forward. And then we talked about the history of the financial system that we live in. So it stems back and beyond. This is kind of like the recent history. This is kind of where we are right now, where it all came from. It all started in 1911 or 1912, whenever it was, when the Titanic hit the iceberg. That was kind of the kickoff to the deterioration of our society. And so you can see everything, and this is a pretty big one. That's why it's in bold, 1971, when the US, President Nixon took us off the gold standard. And money basically became an illusion at that point. And of course, we went through the great financial crisis. And then, of course, Bitcoin, a couple months later, the white paper was released. And then the Genesis block, the very first block in Bitcoin, which we're going to be talking about today, the blocks and the time chain, the difficulty, and why Bitcoin is so much different than any other asset, and why Bitcoin is immune to technology. And I want you to just, before we go any further here, I just want to ask yourself this question before we go any further. Do you think going forward that technology is going to get better or it's going to get worse? Is technology going to become more efficient or is it going to get worse? Is AI going to get more efficient? Is it going to be better or is it going to get worse? That's kind of the starting point, because that's the first principles aspect that's going to kick off this whole conversation today. Do you think technology in 5 years from now is going to be worse or better than it is today? So with that in mind, we're going to be talking about why Bitcoin is the only asset that's completely immune from technology. As everything gets faster, cheaper, more efficient, the costs of everything in this world is going to go down. Just think about that. Doesn't that make sense in your head? And this is kind of a page out of Jeff Booth's playbook today. But as technology improves, as we can make things quicker with less, more efficiently, and cheaper, wouldn't the cost of everything fall down? The answer to that is yes. In a fair market, the answer to that is yes. So that's kind of our starting point today. So this week, we just hit a pretty big milestone in Bitcoin. And that is that 95% of the Bitcoin has been mined now. So I just want to show you this. So we're going to start this in January of 2009. This is kind of where everything began. So this was the Genesis block in Bitcoin. This was when the very first block was mined, January 3rd, 2009. So this wasn't very much further past the great financial crisis there. And if you actually look at the very first block that was mined, the Genesis block, there was a newspaper article in there that Satoshi put that said chancellor's on the brink of second bailouts. So that first block, not only was it the beginning of this whole thing, but he wanted to send a message, or he or she or they wanted to send a message and say, this is a direct attack on the central banks. That's what Bitcoin's designed to be. It's designed to separate money from state. It's designed as a peer-to-peer electronic cash system. And in a peer-to-peer system, you don't need middlemen. You don't need centralized entities in there. So that's kind of where everything kicked off here in the Genesis block. So in this Genesis block in 2009, so from 2009 to 2012, this is what we call the Epoch 1. And I thought a lot about putting this episode in this part, but it's one thing that I really wish that I would have understood earlier in my journey. And so there's going to be some things that I talk about in this episode that you don't fully understand. You might have to rewatch this episode a couple times, but I do think it's important because this gives meaning to what gives Bitcoin value. What I'm about to talk about today, it's a little bit more technical, it's a little bit more advanced, but it's the knowledge that you need to understand the value proposition of Bitcoin. So this was an epoch 1. And at this time, every 10 minutes, when a new block is created or mined, 50 Bitcoin are created with that. So whoever mined that block, they get paid essentially. That's their reward. That's the incentive for people to mine Bitcoin, is that whoever mines that block, they get paid in Bitcoin. So in epoch number 1, it was 50 Bitcoin. And then from 2013 to 2000, I guess it was 2012, because some of these it happens mid-year. Bitcoin doesn't pay attention to the calendars that we do. Bitcoin has its own time, its own calendar. So in epoch number 2, all of a sudden, every 10 minutes, what used to be 50 Bitcoin every block came down to 25 Bitcoin per block. So that's a pretty big shock. And that's why we saw so many ups and downs throughout Bitcoin's history in terms of the US dollar, because this generated a lot of interest. When that block roared, when the payouts were cut in half, the demand for Bitcoin went up because they knew that they weren't coming out as quickly anymore. So think about that. Of the 21 million Bitcoin that will ever exist, 10.5, oh, what did I do there? 10.5 million Bitcoin were now in circulation. So on this date here, January 3rd, 2009, there was 0 Bitcoin in circulation. 0. After the first epoch, there was now 10.5 million Bitcoin in circulation. So all these Bitcoin that were mined, 50 Bitcoin every 10 minutes, they were distributed to all the people who were mining Bitcoin at that time, which was like 10 people. So the first 10.5 million were actually generated, mined, and put into circulation in the first 4 years of Bitcoin, approximately. So the next part here, the epoch 2, 25 Bitcoin per block, 25 Bitcoin every 10 minutes. That was about what, 5.25 Bitcoin? I'm not going to try to keep doing math from there, but you get the idea here. So if we go like this, I wonder if this is going to help me out. Yes, no, it's not. 2016 to 2020. So this is epoch 3. And this was 12.5 Bitcoin every 10 minutes. So again, for the first epoch, every 10 minutes, there was 50 new Bitcoin being created. Second epoch, 25, third epoch, 12.5. And then, of course, from 2020 to 2024, which was epoch number 4, there was 6.25 Bitcoin every 10 minutes. So this is essentially how Bitcoin are created. They're mined. And when people hear mining, they think of like gold mining. And it's actually not too different, right? Because you have to, when you're mining for gold, it actually takes energy. You have people out there, you have equipment, you spend time planning and organizing and finding these different locations. It requires work to get that gold out of the ground. And just like in Bitcoin, it requires real work, real energy to mine Bitcoin, because unless you have a power source, unless you have energy to contribute to the network, you cannot compete. You cannot mine any Bitcoin. So now from 2024 to 2028, which is where we are right now, in epoch number 5, it is 3.125 Bitcoin. And I'm sure you've heard of the Bitcoin halving before and how this whole thing works. And this is exactly how it is. So as new Bitcoin are created, as blocks are mined, those Bitcoin are sent to the miner of that block. It's pretty simple. So that's their incentive for mining. That's the incentive for somebody to take electricity, energy, and contribute it to the Bitcoin network, because they get paid in Bitcoin. So this week, we actually reached 95% supply, which means that 95% of the Bitcoin that will ever exist have now been mined. And so for the first 17 years, 95% of the Bitcoin mined have been mined. For the next 111 years, the remaining 5% will be mined. That's the halving. That's the supply and demand dynamic of Bitcoin. That's the psychology around Bitcoin. That's what gets people interested. And when people are interested, they build and they contribute more to it, to the network. And that's where we are today. So 95% of the Bitcoin has been mined, which means for the next 111 years up until 2136, when the last block is mined, that's all there's left, 5%. And you might think, okay, well, what happens then? And as we get into this further, when we start talking about transaction fees and block subsidies and all this stuff, you're going to see what happens. But to me, this is, I better put in my opinion here because it is my opinion. This is when Bitcoin begins. Everybody thinks that they're late to Bitcoin because the price has gone from $100 to $100,000. But in reality, this is really when the network starts. Because at this point, even though the miners aren't getting paid their subsidy anymore, they get all the transactions, all the transaction fees in those blocks that they mine. So when a new block is mined, and I know this might be a little bit much for some people at this stage, but just try to stick with me here. Every block that's mined has a subsidy and the transaction fees. So the subsidy is the fixed portion. That's these are fixed. So when you're mining for Bitcoin right now, you know, if you hit a block, this is going to be your subsidy. It's going to be 3.125 Bitcoin every block. It's fixed until, of course, 2028, when it gets cut into 1.56. But it's fixed. You know what it is. Transaction fees are variable, and they're variable because it all depends on how busy the Bitcoin network is. So I'm going to show you this. It might make a little more sense here in a second. And I'm going to show you an example of a block here and what this means. So let me take this off for a sec. And I just want to say hi to everybody. I see a whole bunch of comments coming in. It's a little bit hard for me to stay focused here, but I just want to say, hey, I see your comments and thank you for being here today with us. So if I go like this, I'll get to the questions and all the comments after the lesson here. I'm not ignoring you. Okay, so if we go to the mempool here. So this is a great resource for anybody out there. I've spent so much time looking at this website and just playing around with it. But if we look at, you can see the block height here. So I said that Bitcoin doesn't pay attention to human time. This is the time in Bitcoin. This is what time it is right now in Bitcoin. 924194, which means that there's been 924,194 blocks since January 3rd, 2009. Since the Genesis block. So that's the block height. That is the time in Bitcoin. So you can see here in this block, you can see who won it. It was Foundry USA. And you can see exactly how much they made from mining this block. So they got paid 3.138 Bitcoin for a total of 292,748. That was the US dollar value of this block. $292,000 they got paid. So you see why there's so much energy going into the Bitcoin network, because this is the payout. This is the reward for it. This is their incentive. Every 10 minutes on average. And you can see it's on average because this block was 20 minutes ago. This one was 17 minutes ago. And this was 13 minutes ago. So it's not exactly every 10 minutes, but it's on average. And we're going to talk about the average of it in a couple of minutes here. But you can see the subsidy and fee. So the subsidy portion of this is the 3.125 Bitcoin. The transaction fees portion of this is 0.013 Bitcoin or 1.3 million sats. And so this is what the miner gets paid, the subsidy and the fees. So this is the fixed part. This is the variable part. And so where do these fees come from? Well, each block is just a bunch of transactions. In this case, it was 2,896 transactions. And you can see here this Coinbase transaction, the newly generated coins, this is the payout to the miner. So they got 3.138 Bitcoin. So every time somebody sends Bitcoin, they have to pay a transaction fee, which we're going to talk about in a future lesson. But every Bitcoin transaction that's sent on the layer 1 network, you pay a fee with that. And so all those transactions that get put into a block, all the fees associated with those transactions, those all get paid to the miner, whoever mined that block. The miner gets to decide which transactions they want to put into their block. They get to design the template with it. So a lot of miners will choose the most profitable version of it. Obviously, whoever's willing to pay the most, that's the transactions that get put into the block. And so that's kind of the supply and demand dynamic of the Bitcoin blockchain. So all these, we'll talk about this later, but you can see all these transactions that are waiting to be put into a block here. It's about 40,000 transactions and rising. And so the Bitcoin miners get to look through all these transactions in the mempool here and decide which transactions they want to include in their block. And for the most part, they choose the ones with the highest transaction fees because that's what they get paid based on. Some miners do it differently. Some miners don't want to have any spam in there, so they select them differently. But for the most part, miners choose the most profitable transactions. So if we go back to, where am I here? Oh, crap. Press the wrong button there. Okay, so let's go to, let's bring this back up. Get us back on track there. So that was the variable and the fixed part, the subsidy and the transaction fee. So we talked about how the Bitcoin are created. They're essentially mined every 10 minutes. There's new Bitcoin created. 95% of them are done. How often? It's 10 minutes on average. So again, it's not going to be exactly every 10 minutes, but it's 10 minutes on average. And I'm going to show you what that means here. If I can go back to, where were we there? Let's go to the time chain calendar. I'm going to show you that this has been the case. So this is another really good tool, resource for you. It's called the time chain calendar. So it shows you there. You can see at the top, it shows what epoch we're in right now. It shows you that we've had 95% of the supply has been mined, which is 19.95 million Bitcoin have been mined. So everybody says there's 21 million Bitcoin, but that's not true. There will be in the year 2136, 21 million Bitcoin. But as of today, there's only 19.95 million. And this is the subsidy. This is what the miners get every block, 3.125. This is the exchange rate of Bitcoin. Today is 93,434 US dollars for one Bitcoin. For one sat, or for $1 in the US, you can get 1,070 sats. So this has all the information that you need. But the really cool part about this is you can see here, this is January 3rd, 2009 at the top here. This is when it all began. And this whole circle, this outer ring, is the new supply. So this, after 4 years, we mined 50% of the supply. After another 4 years, it was 25%, or now 75% of the supply. And then another 12.5, and then 6.125. And so that means that for the next 111 years, this is the remaining Bitcoin to be mined right here. So the first 17 years, all of these coins were mined, first 17 years, and the next 111 years, that part right there. And then if we scroll down, we can see more metrics from the network. And you can see here, since the Genesis block, since January 3rd, 2009, this has been the average block time. 9 minutes and 36 seconds. So there's been times where it's been bang, 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 3 blocks in 1 minute. There's been times where it's taken 1 hour for 3 blocks to come in. But on average, over the last 17 years, each block has been 9 minutes and 36 seconds, block by block, 1 block at a time. That's kind of the clock, tick, tick, tick. Each block, that's the Bitcoin networks, the time chain. That's the frequency of the network. Every 10 minutes, new block comes out. New Bitcoin are created. New transactions are put into the network, onto the ledger. They're there forever. And the reason why they're there forever is because every time there's a new block, everybody who's mining a node, they get a new updated version of the ledger. Whoever runs a node, they see every transaction that's happened since January 3rd, 2009. And every time there's a new block, that new updated ledger gets broadcast to, what is it here? 23,000. These are public nodes. There's a lot more than this. but 23,000 nodes around the world get an updated copy of the ledger, the time chain, every 10 minutes on average. So now if we go back to our thing here, back to our sheet. So the Bitcoin network, how does a miner win a block? I guess that's the question here. How does a miner win a block? Well, it's totally random. It's totally random. And every second, anybody mining Bitcoin, I have a BitAxe back here that's mining Bitcoin, and all that miner's doing is it's just guessing. It's trying to guess the block equation. Miners are simply, there's probably more technical nuance to this, but we're going to keep it very simple. Miners are simply trying to guess the equation. And the more computational power, the more guesses. Okay? So for the miners, the big miners who have a lot of computational power, they get more guesses. They have a better chance of winning the next block. So the more energy you contribute to the network, the higher your odds are of winning. The more energy you contribute, the higher your odds are. But it's still completely fair. Like I could win a block with this, something you can't even hear. It's giving off no heat. And I just wanted to show this because this is kind of amazing to look at. So when miners first started back in 2009, we measured the hash rate, or the total energy going into the Bitcoin network. That's all hash rate is. It's the total amount of energy being directed towards the network, securing the network. And this is how we measure it. Think of like the data that you store on your computer or your iPhone. It's like megabyte, gigabyte, terabyte. I think it's terabyte. Is it terabyte? I don't know. But it's the same kind of thing. So when they first started mining, when Bitcoin was first, when it was brand new, you could actually mine Bitcoin with a GPU, like a laptop, because there wasn't that many people, there wasn't that many miners competing. So that was when it was megahash. So every second there was a million guesses. And we're going to look at the graph of the chart of this right away. But then we went to gigahash, which was 1 billion guesses per second. And then terahash, which was 1 trillion, petahash, quadrillion, exahash, quintillion. And this is where we are today. We actually just hit this milestone about a month ago now. We're in zetahash territory. Sextillion. So 1 sextillion guesses every second. And you can see here the difference. Million, billion, trillion, quadrillion, quintillion, sextillion. So for the last 17 years, this is how much the Bitcoin network has increased in terms of the energy going into the network. Pretty powerful. And it just kind of looks like numbers on here. And even when we hear million, billion, trillion, quadrillion, it's just words. It's just things on a computer. But like if we look at what it really means, 1 million seconds ago was 11 days ago, November 7th, 2025. 1 billion seconds was 32 years ago, 1993. And 1 trillion seconds ago, this is mind-blowing, was 31,700 years ago. So you can imagine what quadrillion would look like, and quintillion in terms of its actual magnitude and scale. Again, it just sounds like words and numbers, but like when you actually put this at scale, it is mind-blowing to think about. The human brain can't actually comprehend any of this stuff. So if we go back and look at if we go back to the mempool here, you can actually use this tool at the top here. There's this little axe looking thing, and you can look at the all-time hash rate in Bitcoin. So if we look at all here, this is my favorite chart in Bitcoin. Where is it? There we go. So you can see back in 2009, this was when megahash, this is when you could mine a Bitcoin block and get paid 50 Bitcoin on your laptop. And then as more and more people showed up, we increased to gigahash, and then to terahash, and then to petahash. And then in 2016, we got into exahash, which is where we spent the next decade. So you can see the magnitude of this, right? Because we went from megahash to gigahash to terahash to petahash, and it looks like a flat line here. And then all of a sudden we went to exahash, and that's where we stayed for the next decade. And then last month, as you can see here, we crossed into the zetahash territory. So the point of this lesson today, more than anything else, is to show you that as technology improves, so do the efficiency of the miners. And as the miners become more efficient, they can spit out more guesses. And so you might be thinking, well, if that's the case, if technology is going to improve that much, won't blocks start coming in faster? If technology is getting better, if it's improving, we should be able to find these blocks quicker, right? That would make sense. But that's why we have the difficulty adjustment, which is maybe what we'll spend the next show talking about, because it is probably the most important part of Bitcoin to understand, the difficulty adjustment. But you can see here, if we go back to the main screen, it'll show us the, that's not what we want. Where is it? Where's the difficulty here? Oh, right here. Geez, too small for me. This is the difficulty. So basically every 2016 blocks, again, Bitcoin doesn't care about human time. It makes its own time. So every 2016 blocks, the difficulty adjustment either goes up when there's more people mining, makes it harder for them, or it goes down when there's less people mining, gets easier for them. And the whole purpose of that is to keep the blocks coming in every 10 minutes on average. That's the clock. That's the tick every 10 minutes. And so that's what the difficulty adjustment does here. So keep this in mind. I know that's a lot, especially if you're someone new to Bitcoin, but we're going to talk about why that matters. So if you compare anything, and again, we're going to go further into some of these topics in a future lesson. So don't feel too overwhelmed. Don't feel like, you're crazy, because it took me probably 3 years, honestly, to figure all this stuff out myself. So that's the whole thing in Bitcoin, is like, you don't need to move too fast. You just have to be open-minded, consistent, and you have to put in the work, just like Bitcoin miners. The whole Bitcoin ecosystem is based around proof of work. So the point is that when you go out into the world, you're going to a job, you have a business, you're creating products or service, whatever you're doing, you get value. You get value back. Basically, how much value you add to the world, that's how much value you get back. And so the nice thing about Bitcoin is that it's the perfect store of value. It's not don't think about Bitcoin as an investment. Don't think about it as something that's going to turn your $1,000 into $100,000 in the next couple of years. Think about it as a savings tool, because it's the best battery. It's the best store of value. And I'm going to kind of explain the implications of technology here and why Bitcoin is the only asset that is actually going to store value, because everything else is going to go down as technology goes up. So let me put that at the top. Everything else besides Bitcoin is going to fall as technology improves. Everything else is going to fall as technology improves. It's easier to make things. It's cheaper to make things. It's more efficient to make things. It costs less. The prices fall. So human productivity, we're seeing an example of that these days, where AI, where you can basically download it or use it for free very quickly, is cheaper than paying a human being to do that same work. So humans are going down in value as technology improves. iPhones, as technology improves, as we can make things cheaper, faster, more efficiently, the price of an iPhone should fall. Right? Just think about that. As it gets easier to make things, the costs should go down. And if the costs go down, then the prices should also go down. Vehicles, same idea, exact same as an iPhone. As it gets cheaper and cheaper and more efficient as you can make these things, and even if you compare it to 50 years ago, where there's human beings on a production line installing these parts, making these parts, compare that to today where it's all automated, all robots. The price of things, the cost has gone down significantly because there's much less work required because we've become better at it. Technology improved. We're more efficient at it. So the costs of these should fall. The prices of vehicles should fall as technology improves. And they actually are, which I'm going to show you in 1 second here. Same with real estate. As all this happens, as technology improves, we can find better ways to build more efficiently. We can use better products that are cheaper, quicker to assemble, less humans required. The cost of a house should be going down and the prices of houses should be going down. Same with gold. Gold's the closest thing to Bitcoin. I would say that gold's the second hardest asset compared to Bitcoin. But even if you think about it, as technology gets better, we're going to be able to survey land better. We're going to be able to use better equipment, get deeper into the earth. We're going to be able to find more gold quicker. And then, of course, Bitcoin is the only thing here that actually doesn't, that is immune from technology improvements. Why? Because what we just talked about there. As miners, which are essentially like the equipment that you would be mining, what are those things called? I'm drawing a blank here. The equipment used to mine gold, essentially, that would be the equivalent of like a Bitcoin miner. As technology improves, we increase our guesses, we become more efficient, and we should be able to get Bitcoin quicker, right? Just like everything else. Except the answer to that is no. And the reason for that is because of the difficulty adjustment. That's the key. And so this has a lot of different implications with this because number one, if you think about iPhones, if you think about vehicles, gold, real estate, all this stuff, as demand increases, right? As more and more people want an iPhone, if you think back a decade ago, probably 20% of the population had an iPhone. Now everybody has one. So as demand for these products goes up, you can increase supply to match that, right? You can increase the supply to match that. And that's what they've done. They've supplied the planet with iPhones because of technology advancements. They can make them cheaper, quicker, everything. So supply can meet demand. Same with vehicles. Same with real estate. Same with gold. As more and more people want these assets, we can just produce more because we're getting better at it. We can do it for cheaper. And so any demand that's built up, we can meet the supply. And if you understand supply and demand dynamics, that means that the prices, as supply catches up with demand, the price flatlines and then actually starts to fall because it's getting cheaper and cheaper to make these things. So Bitcoin is the only asset here that is completely immune from technology. Because as the miners get more efficient, we should be able to make more of it. We should be able to get those blocks coming in faster and faster, right? But because of the difficulty adjustment here, that breaks that. And we have proof. We have proof for the last 17 years, the Bitcoin blocks have come in on average 9 minutes and 36 seconds. So this obviously works because as more people and companies are mining, the difficulty goes up. As less people and companies are mining, the difficulty goes down. So it works both ways, right? Because if all of a sudden half the network shut down, then it would take a lot longer for those blocks to be found. Because now there's half the amount of miners who are spitting out guesses. There's half the amount of guesses per second as there was before. So it's going to take double the amount of time for the next block to come in. So that's why the difficulty adjustment goes both ways. When people plug in miners, the difficulty goes up, makes it harder because there's more people competing. As people unplug their miners or power down for numerous reasons, the difficulty adjustment goes down. So the blocks on average can keep coming in every 10 minutes. So there was a famous line from Jack Mallers who said, gold is stuck in the ground. And this is a very good way to visualize it and a very good way to end the lesson here. Bitcoin is stuck in time, which means that no matter how much technology we have, no matter how efficient the miners are, no matter how many guesses per second we have going, we cannot get Bitcoin any sooner. We cannot shortcut the supply schedule that we talked about there. It's fixed. It's known. It's predictable. And when things are predictable, you can more accurately measure things against them. So whereas gold is stuck in time, the more technology you have, the more energy you have, you can get that gold out of the ground quicker, cheaper. You can meet demand. The supply can meet demand, which eventually flatlines the price and then starts coming down. Bitcoin, on the other hand, is stuck in time. There's nothing that you can do to shortcut that. You might get away with it for 2016 blocks. You might get the blocks coming in faster, but when that difficulty adjustment kicks in, it's back on track. And that's why we've seen that in fiat terms, in a broken system, all of these things are still going up in price. It's getting more expensive to make them, even though technology is going up. It's getting better. It should be getting cheaper and cheaper. But because of the fiat system, prices continue going up. So that's the whole reason why we're leaving that system. So if you think about it this way, a house in 2015 cost what? Let's just say 10,000 Bitcoin. A house in 2020, maybe it cost 100 Bitcoin. And a house in 2025 costs 5 Bitcoin. So in a free market system that's not manipulated, this is what happens. Things get cheaper. And that's what Bitcoin is. It's repricing everything. It's remeasuring everything from a free market perspective, from a deflationary environment. And so this has been happening. This isn't like my predictions for what's about to play out here. This is what has happened. So even though the price in fiat of that same house might have went from 300,000 to 400,000 to 500,000, in fiat terms, it looks like everything's going up in price, but in Bitcoin terms, everything's dropping in price for all these different reasons that I just explained. So that was way over my time limit for these lessons. And I jammed as much as I could into that. I don't think I took a breath that whole 40 minutes there. So that's lesson number 4. We're probably going to do a follow-up of this in terms of the difficulty adjustment and maybe some other things next week. But I really want to keep these as short as possible and as digestible as possible for people. So again, we do these every Tuesday at 2 p.m. Eastern time. I do a replay of these every Saturday morning at 10 a.m. Eastern time, which is just the lesson part of it. So if you want to just rewatch it, or if you missed the live that week, you can just show up on Saturday and watch it. And it's just the clip. I also do live shows called the Visionary Show every morning at 10 a.m. Eastern time on different platforms. I'll just say that. You can find me if you really want to, but we do a show every day. And so I encourage you, if you're interested, if you're learning anything here, this is the kind of stuff we talk about every single morning. So it's important stuff to understand, especially when the price is dropping like it is right now and everybody's freaking out. You got to go back to the first principles of this asset and really understand what's happening here. Because I would say that the price is probably the least relevant metric in the long term about what's playing out here. So that's lesson number 4 for 88 lessons.